Good evening, students. Today we will discuss chapter 8 of corporate finance, that is bond valuation. We will see the important bond features and types, understand bond values and why they fluctuate in their pricing. We'll see how bond ratings work and how they mean to the bondholder and the investors. Understand the impact of inflation on interest rate. So once inflation happens, whether interest rate increases, decreases, and accordingly with interest rate, how the bond price is changing. So the outline will be, first section will be talking about bonds and bond valuation. And the second section will talk about government and corporate bonds. Third section will talk about bond market. And we will see, as we saw there in the previous slide, inflation and its impact on the interest rates, the determinants of bond yields. Let us start now. Bond is a legally binding agreement between a borrower and a lender. So bond is a legal binding, that means legal contract. Between whom? Between a borrower, that is the company, or the corporate, or the government who issues the bond, and a lender. Lender is the bond holder. So I hope it is clear. It is a binding. That means agreement which is legally binding, or it becomes a contract. Contract between whom? Borrower and lender. Here borrower is the company or corporate or the government, or sometimes municipality. Who is the lender? Lender is the bondholder. This legal agreement or contract, it specifies few things. What are they? It specifies the par or face value. The face value or the par value is the value on which the coupon or interest is calculated. Always the par value is the reference point. The interest is calculated on the par value. Similarly, when the bond completes its period, the company returns the par value to the bondholder back. So par or face value is the reference point. Coupon rate is the rate of interest the bond pays to the bondholders. So whatever the coupon rate, it is being mentioned in the bond certificate or bond indenture. Coupon payment will be done either annually, semi-annually, monthly, quarterly, depending on the agreement. If nothing is mentioned in the bond certificate, the coupon is paid semi-annually. That means twice in a year, every 6 months. Maturity date is the date when the bond finishes its period. The company returns the face value back to the bondholder. The yield to maturity, or YTM, very popularly we call it YTM, is the required market interest rate on the bond. So YTM is the rate which is required by the bondholder, or the market interest rate the bondholder claims on the particular bond. Or we can say, what should be the rate the bondholder notionally will get if he holds the bond till the maturity. That's why it is called as YTM, yield to maturity. What interest rate he yields on the bond if he holds it till the maturity of the bond. We will see more on that. Now we come to the valuation of the bond. So the primary principle of the valuation of bond is equal to we will come back to the valuation of bond, but before valuation of bond, the base principle or the primary principle is any financial security you have to make valuation. What you do? You try to find out the present value of expected future cash flows, isn't it? If you want to value any financial security, stock, bond, any, option, future, whatever. If you want to value any financial security, the valuation will be or preferred equity or common stock, bond, debenture, all the financial securities valuation principle is present value of expected future cash flows. Bond value is no exception. Bond value is therefore determined by the present value of coupon payments and present value of par value. So two types of future cash flows we derive from bond. We derive two types of future values from a bond. One type is the coupon payments. So present value of coupon payments to be done because we get coupon payments periodically from the bond throughout its life. We have to make the present value of coupon payments. The second type of cash flow from a bond is the par value when the bond finishes on the maturity. The second type of cash flow is the par value on the maturity of the bond. Therefore, present value of par value also to be calculated. So two types of cash flows are derived from a bond. One is coupon payments, the other one is par value. Present value of coupon payments plus present value of par value is equal to bond valuation. Interest rates are inversely related to present value or bond prices. Remember this. This is a very grounded theory which will be used in many of the slides. Interest rates and bond price are inversely related. That means if interest rate increases, bond price decreases and vice versa. If interest rate decreases, bond price increases. So there exists an opposite relationship between bond price and interest rates. Just before slide we have discussed the basic principle of financial security valuation is equal to financial assets valuation is equal to present value of future cash flows. In a bond you get two types of future cash flows. One is coupon, the other one is future face value. Now let us understand coupons are paid multiple times. For example, if a bond gives annual coupon for if the life is 20 years, the company will give 20 coupons. If the bond pays coupon annually and it is for 20 years, the bond will pay here 20 coupons. For example, rate of interest is 10%. Face value is 1000. That means 10% of 1000 is 100. Every year it will give $100 as the coupon. And for how many years it will give that? 20 years. Therefore, 20 coupons of $100 each yearly. So it is multiple payments of a fixed amount at a fixed interval. Multiple payments, 20 years, 20 times. Fixed amount, 10% of 1000, that is 100. Fixed duration, that is yearly. Therefore, it became an annuity. It became an annuity. So, present value of annuity formula we will use here. Similarly, the bond pays face value at the end of maturity. Here we have taken face value 1000. So after 20 years, the company will pay, the bond will return 1000 to the investor or bondholder. It is after 20 years, the company will pay once, single payment. Future value or face value is always a single payment. Therefore, the single payment face value, present value formula we will use. For making the present value of the face value or par value, we use the single payment present value formula. Just let us go to the time value of money, put the valuation here. Present value of annuity is equal to, you remember the formula for annuity present value, that is the Coupon multiplied by 1 minus 1 divided by 1 plus r to the power t whole divided by r. So we have used that formula here. The cash flow here is the coupon multiplied by 1 minus 1 divided by 1 plus r. R is the YTM to the power t. T is the number of period or number of years. Whole divided by r. Again r is the YTM. Because it is an annuity, we have used present value of annuity. Face value is single time, end of the bond, here 20 years, and face value is 1000. So 1000 will be paid after 20 years, single payment. Therefore, present value of single future value is equal to future value divided by 1 plus r to the power t. Here, future value is the face value divided by, that is 1000, 1 plus r is the YTM, 10% here, or whatever percentage given to you, 1 plus r to the power t. So this is the way we make the bond valuation. Here, this is a generalized formula. We have seen how to make the bond valuation. Bond involves two types of cash flow. Number one is the coupons, which is multiple payments, multiple periods, multiple payments, fixed amount, fixed time interval. So it is an annuity. The formula for annuity present value is equal to the cash flow multiplied by 1 minus 1 divided by 1 plus r to the power t whole divided by r. R is the YTM, will be given in the question. Face value is a single payment. Future value is a single payment, which is the face value here, divided by 1 plus r to the power t. R is the YTM. T is the number of periods. Let us see an example here. Consider a US government bond with a 6.38% coupon that expires in December 2023. The par value of the bond here is 1000. Coupon payments are made semi-annually. Normally, coupons are paid semi-annually if not mentioned. If mentioned, it can be as mentioned, annually or whatever. But here it is semi-annually, once in June 30th. The other coupon is on December 31st for this particular bond. Since the coupon rate is 6.3 by 8%, the semi-annual payment will be 31.875. 6.3 by 8% of 1000 is equal to 31.875%, $31.875. So what it will do? 31.875 is the annual coupon. Now it will be divided into twice. Once it will be paid on June 30th, the other coupon will be paid on December 31st. So total 31.875, 6.3 by 8 is equal to 63 point, how much? 31.875 multiplied by 2, how much? 31.875 multiplied by 2 is equal to 63.75 is the annual coupon. And it will be paid twice, means divided by 2 is equal to $31.875 every 6 months. June 30th, 31.875. December 31st, again 31.875. Clear? You see the time, the distribution of cash flows given here. Because the bond is issued on 1st of January 2019, the first coupon will be paid on 30th of June 19. Second coupon 31st of December 19. Third coupon 30th of June 20. Then 31st December 20. Like that, the last coupon will be 30th of June 2023. And the last but one is 30th June 2023, and the last coupon is 31st of December 2023. This is the way the coupon will be paid. Alright, clear? Now, another example. On January 1, 2019, the required yield is 5% because here the coupon and face value are given to you. 6.3 by 8% of 1000 is equal to 63.75. which will be distributed twice a year, 31.875, 31.875. It will be paid from 1st January 19 to 31st December 2023. The YTM or the required rate of return is 5% here. Then the bond value will be very simple. Whatever coupons you will get, present value of that, whatever face value you will get after the completion of the bond, that is 2023 31st December, 1000 you will be given by the company back. So present value of that. Here 5-year coupon, semi-annually means twice a year. That means 10 coupons will be there. 10 coupons of 31.875. So it became an annuity, isn't it? 10 coupons of 31.875 became annuity. 10 times 31.875 will be given to you. That means it became annuity. You see, 10 times the 31.875 will be given to the bondholder. So it becomes an annuity. Present value of annuity formula is equal to the cash flow multiplied by 1 minus 1 divided by 1 plus r to the power t whole divided by r. R is equal to how much? The YTM is 5%. 5% annually. That means semi-annually it will be 2.5%. 5 divided by 2. So 31.875 divided by 5 divided by 2 YTM. 1 minus 1 divided by again 1 plus YTM to the power t. T is 5 multiplied by 2, 10. Plus there will be one face value at the end of 5 years or end of 10 periods. So 1000 divided by 1 plus r to the power t. R is equal to 5% divided by 2, 2.5%. This is the way we calculate the valuation of the bond. 1060.17 is the present value of the bonds, all future cash flows. And if you have a calculator, in the n you can add 10, IY 2.5, PV you don't know, PMT will be 31.875 because the rate of the coupon multiplied face value divided by 2 will be 31.875. Face value is 1000. Compute PV will give you the present value. But we are focusing more on the Excel spreadsheet. So this is the way you get the calculator, the present value. So I will stop here, just give me a minute.